Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode.
Yes, this kicks off a bit of a deep dive that we're going to be doing into listed investment companies, something that you spoke about at the start of the year, Ren, as an area of focus for you. And we're starting with one of the big hitters in the industry, Magellan.
Go straight to the biggest.
Yeah.
That's our plan.
So we're joined today by Chris Wheldon, who is a portfolio manager at Magellan, and we'll get into a bit of detail as to what he's managing. But firstly, Chris, thank you for joining us.
Pleasure, guys. Thank you for having us.
So Chris joined Magellan in 2007, initially as a senior investment analyst working in the franchise team, and then was promoted to become the head of the industrials team. He moved to the Magellan office in New York, which would be awesome, living the dream, in 2015, and 1 year later left to join Davis Advisors as an analyst. But then moving back to Australia in 2018, rejoining Magellan as a portfolio manager, and now portfolio manager of their high conviction fund. So yeah, welcome to the show, Chris. Thanks for your time. Very much looking forward to unpacking listed investment companies, Magellan, and certainly what high conviction fund actually means.
Sounds good.
Before we do that though, we always like to start with a game to get a sense of our expert investors and how they think about certain topics. The game's overrated or underrated, so we'll throw out a theme, index or something like that, and you tell us if you think it's overrated or underrated. You willing to play?
Yeah, with a grain of salt.
Well, look, we've had someone from Vanguard on who said everything was fairly rated. So
Killed the whole game.
Yeah. I'm sure your grain of salt isn't that big. But if we start at home in Australia, the ASX 200, overrated or underrated?
Let's start with overrated on the ASX. That's a bit of Magellan bias there. We should think a bit more global exposure in people's portfolios.
So then if we go globally, the S&P 500.
Probably underrated, and that's really subject to people's time frame. But, a long enough time frame, owning something like the S&P 500, owning corporate America, that's probably a pretty good place to invest.
I like it. Overrated or underrated index funds?
Probably underrated. Again, the ability to access, depending on the index, okay, so we should be very clear about that. But again, if you're able to sort of access a good portfolio of businesses at a very low cost, that's probably going to work out pretty well for most people over a long period of time.
Interesting. Wasn't expecting that from someone who works for an active manager.
The industry has a bad rap, and the active industry that is, and deserves a lot of the rap that it's got recently. We've all seen the figures around the number of active managers underperforming and who don't deserve the fees they charge. So there is certainly a role for index funds.
Nice. Is there a role for Bitcoin, overrated or underrated?
that might be a pass. That is a big grain of salt. I have no idea on Bitcoin.
Fair call.
Fair enough. And then last one, a topic of heavy conversation in recent years, Australian residential property, overrated or underrated?
Oh, I'm going to say overrated on that one. But that's a personal bias. Love to see it a lot cheaper. That's a very selfish statement. But owning a piece of Australian property would be wonderful, but I just can't make the numbers work at the moment.
So Chris, to kick off our interview, we always like to understand people's first investments. We generally find there's a good story there or there's a good lesson that comes out of it. So to kick off today, can you tell us the story of your first investment?
Yeah, it is a really good question. Thank you for sending these through in advance, because it does give you a chance to reflect and actually think about some of the things that might be worthy of passing on. And it's an interesting question, not so much for the things that I did or didn't own and what I bought, but for the sort of journey that it started. Because if I think back to I was sort of probably early to mid-teens when I bought the first basket of stocks that I bought here in Australia. And I've kept the trade certificates, the buy confirmations, all those sort of things. I reflect back on them occasionally, and I have absolutely no idea why I bought what I bought. It was probably, I was probably enchanted by some technical analysis and charting and all the non-fundamental, effectively get rich quick stuff that you're initially attracted to. And the best thing that happened, and I emphasize and stress the word best thing that happened, is that it didn't work out and I lost some money on those investments, not surprisingly. And that forced me to pause and reflect and sort of think through why it didn't work and other ways of investing. And that's really been the journey that's taken place since then over the last couple of decades, is starting to read more broadly and You get introduced to, people like Ben Graham, and you start thinking through and you start learning about margins of safety, Mr. Market, some of his very important core principles. And Graham leads you to Phil Fisher, and you learn about the importance of quality businesses and their ability to compound over time. And that leads you to Buffett, of course, who has so many lessons that we can all learn from. But things like circle of competence, his idea around being a better investor because he's a businessman, just the way he's conducted himself in business over decades now and the reputational advantage that he has. Incidentally, both the two jobs I've had since university have both come from meetings I've had at the Berkshire AGM over in Omaha.
Wow.
So there is that part of it as well. But Buffett leads you to Munger as well, who is just, this philosopher in terms of the acquisition of worldly wisdom and lifelong learning. And again, how to conduct yourself in the world. And from there, you go to Seth Klarman and the importance of margin of safety and risk disciplines, the importance of a team, to Howard Marks in terms of, how he thinks about market cycles and thinking probabilistically and all those things. So who knows where it all would have ended up, but for that great fortune of having lost some money initially in a very strange way, it was that experience of having it not worked out initially that sort of just got on this knowledge of trying to learn more about investing and the important concepts that have proved to be timeless for a lot of these great investors.
Before we get into your career, I want to pick up on something that you said there. So you've been to multiple Berkshire Hathaway AGMs. What was the reason you went for the first? Was it job hunting? And what was the experience like there?
No, it's just been, I'm an investment nerd. I've sort of always, for better or worse, known what I wanted to do. And I was very fortunate that not long after graduating the University of Queensland, I had heard of Chris Mackay and Hamish Douglass, the two co-founders of Magellan, and read that they were starting up a business. And I just sent off a handwritten letter to Chris, asking if they would be at the Berkshire Hathaway meeting, which must have been 2005 or 2006, one of those years. Maybe it was 2006. And Chris replied back saying, yes, we'll be over there. It'd be lovely to sort of meet another Australian while we're there. Chris was initially there, but whether he summed me up very quickly, he passed me off and palmed me off to Hamish. And I spent the next sort of couple of hours with Hamish sitting in a hotel lobby in Omaha. And Hamish being Hamish, was a sort of one-way conversation of him pitching the investment case for eBay and for Wells Fargo and for a bunch of other stocks that he was thinking about at the time. As I think about it, must have been 2007. This would have been May 2007. And we wrapped up that conversation. There was sort of nothing going at Magellan at the time, but we kept in touch. And sometime, I think in August or September that year, I got an email from him saying, a junior analyst role at Magellan has opened up. If you want to come, I was still traveling in the States at the time. He said, if you want to jump on a plane and come back, come and join the interview process. And I was lucky enough to get through that. Wouldn't happen today, by the way. The standards have certainly increased since then, but was lucky enough to get the role back in 2007. And then, as you mentioned in the intro, back in 2016 or 17, while I was in New York with Magellan, I departed the company briefly and went to work for Chris Davis at Davis Advisors. And Chris I'd also met at one of the Berkshire AGMs over there. And your question around what's the experience like, it's incredible. I mean, it's wonderful to sort of sit at the feet of these two geniuses. I mean that both in an investing sense, but also much more broader than that, particularly Charlie, who is just so broad in his knowledge across so many different disciplines, to get some exposure to that and then to get some exposure to the community that they've developed. And that's one of the things that I love most about those two guys is outside of their success in investing, just the way they've thought about behaving in the world and how they've instructed others in that journey. They've just got a lot of like-minded, very high-quality people in that community on the shareholder register at Berkshire. And they're all in one place at one time over that weekend in Omaha. So it's great to go there and meet a lot of these people, get exposed to their thinking, their ideas. And you don't know what will come out of those sort of events. Fortunately, now with Yahoo televising, you don't have to jump on a plane and fly to Omaha anymore. You can still sit there and early on a Sunday morning our time, watch the AGM unfold. But being there is pretty special as well, just because of the access to some wonderful people that you'll meet over there.
Definitely on our bucket list.
100%, yeah.
We watched listened to the 8-hour audio last year while doing the chores at home, which, we should certainly up that soon.
Yeah.
Get over there.
Yeah, soon's probably important, right? I mean, unfortunately, these guys are getting later in their innings.
So let's fast forward to now. The whole reason we're doing these episodes is to expose our audience to the many different strategies that exist in these listed investment companies that are available on the ASX. And you're co-portfolio manager of Magellan's High Conviction Fund. Let's just start with that. Can you explain the concept of high conviction investing?
Yeah, you bet. High conviction investing, it's funny. Many people, so we've effectively got two strategies at Magellan. There's our global equity strategies and our listed infrastructure strategy. And both of those two strategies people would look at, and the global equity strategy is really represented through the Magellan Global Fund, which has been around since 2007, where Hamish Douglass is the lead PM. Most people see that, which is typically a 25-ish stock portfolio, and think that is quite concentrated. And then we have our high conviction fund, high conviction trust, which is 8 to 12 stocks. And so that really gets people's attention in terms of the concentration and the conviction of some of the positions in that fund. The idea is, in a high conviction portfolio, you are trying to expose investors and yourself to the very best ideas that you can find when you look all over the world. And that's what we do in our high conviction fund, high conviction trust. It's an 8 to 12 stock portfolio. We are trying to find world-class businesses. What we're trying to do really is wait for the stars to align. And you're trying to find the world-class businesses run by honest and capable management teams, businesses in great industries with attractive industry structures and long-term growth, all those sort of things, and just be patient and wait for them to become available in markets when there's a large margin of safety available. And the rest of the time, fortunately, you just get to be patient and disciplined and wait for those opportunities. A small portfolio like that lends itself to infrequent decisions. We will act when we need to. If it's appropriate that we sell something or trim something, we'll certainly do that. But it also gives us luxury of time and patience where we don't need to fill a 200 stock portfolio with new ideas all the time, which would be really challenging. Something much more concentrated like that, you're really focusing your bets. Of course, the potential other side of that coin is that mistakes are amplified. These are going to be large positions in your portfolio. And it is a portfolio where people have to think through whether they have the sort of psychology to endure the inherently higher volatility that will come from owning much larger positions in businesses where the price can move around a lot. The underlying intrinsic value may not move so much, but prices certainly move in markets, and that's not for everyone. That's fine. But what we're doing with our high conviction portfolios is really trying to find those best ideas, wait patiently for them, buy them when they're cheap, and then with our long-term investment horizon, which we apply across all of our funds at Magellan, just allow those really high-quality businesses to compound for clients over time at an attractive level, recognizing there will be some bumpiness to that return profile, just given its inherent concentrated nature.
With the markets globally, particularly America and Australia at the moment, on an absolute tear, is it harder and harder to find, stocks to fill these 8 to 10 positions? And I guess, have you been waiting patiently for a while now? Crazy job.
Yeah, what do we do the rest of the time? Yeah. Is it getting harder? To a degree, yes. I mean, we would love these wonderful businesses to be available at cheaper prices, but it's not hard in an absolute sense at the moment. It's harder relative to where it was maybe 5 or 10 years ago. But again, I sort of come back to that point that there is a genuine luxury and a genuine advantage we have at Magellan, whether it's in our 25-ish stock portfolio, which is the global fund, or our 8 to 12 stock portfolio, the high conviction fund. We don't need to find a lot of ideas in any given period of time. And we also have an incredible, and I strongly mean this, an incredible investment team at Magellan, about 30 people, who are covering a couple of hundred businesses around the world, different geographies, different regions, different sectors, different industries. And markets being what they are, there's always things that are in favour and out of favour. And if all you're trying to do is find maybe 1 or 2 great ideas a year because something else has become expensive, or you're a bit worried about the quality or the prospects or something like that of one of the current holdings, if all you need to do is find 1 or 2 ideas a year, and you've got an incredible team of 30-odd analysts covering a couple of hundred businesses, yes, is a little tougher in a relative sense, just given where prices are today, but we've still got plenty of things. First of all, the things we own in the portfolio, very comfortable with. And then there's plenty of ideas around the portfolio as well, things we don't currently own, but we would happily own if the prices of the current holdings were to I don't know, go up another 20, 30, 50% or something like that. There are things that we could rotate into.
The process of having 30 analysts, which they would all have their own convictions and then all covering, the global stock markets, the all investable stocks, it must be a very difficult process to whittle that down to 8 or to 12 stocks that you're actually going to buy. Can you take us in the room of your investment committee and sort of tell us how the 30 analysts thumping the table for their highest conviction stock gets whittled down to a high conviction portfolio?
Yeah, sure. It's such a good question. From an investment point of view and the success or modest success we've had at Magellan over the last decade, I'd really attribute to two things. One would be the process that we've built, and we'll touch on that because that's part of your question. And the other, again, I'd just stress the importance of the team. All those analysts, the different portfolio managers, our head of research, head of investments, all those people play a role in that process. And so the way that process works, because we don't really have people thumping the table, and that's an important part of what we're trying to do. We're not trying to be too market sensitive and get aggressive when things look really cheap and, sort of get too carried away with what markets are doing. It's that sort of short-term voting machine argument of Ben Graham versus the long-term weighing machine of company fundamentals and economics over time. That's what we're really focused on. But we'd certainly encourage and involve the investment team to speak up if they have an idea. But the idea generation process, the way it really works and how it involves our investment committee, because I think this is quite important and a unique part of Magellan and our process. The investment committee at Magellan is not a portfolio committee. The investment committee is about 13 senior members of the investment team. And the role they play is to allow a stock into our investable universe. And in that process, they don't pay any attention to price or to value or anything like that. The investment committee votes only on whether a business being reviewed meets our quality criteria or not. And we apply a very high quality filter at Magellan. That's why we've got, notwithstanding the ability to potentially cover thousands of listed companies around the world, we only cover a couple of hundred because we've only become comfortable over time with a couple of hundred businesses around the world that meet our strict quality criteria. So that's the role of the investment committee, is effectively a filter, just only allowing the highest quality businesses on the planet onto the shopping list effectively, from which Hamish can construct the portfolios. And the portfolio management team, which is effectively Hamish with some assistance from a few others, given he has the final decision, what he's trying to do there is optimize, the risk and return profile of a portfolio at any point in time, given his view on the companies and his view on the world and the amount of risk that we want to take in the portfolio, whether we want to be particularly aggressive at a certain point in the cycle or particularly defensive at another point in the cycle. Because he has this shopping list of a couple of hundred businesses, gives him a lot of flexibility of moving the portfolio around, always keeping very high quality businesses in the portfolio, always making sure we are very strict on valuation discipline and things like that. So if an analyst has a great idea, they can bang the table if they want. They needn't, because there's other avenues of surfacing that idea. It's a very flat and open structure. We tend to talk to each other face to face most of the time. But there are a few other tools within our process at Magellan that will surface those high quality, undervalued ideas at any point in time. But most of it is just, it's a large team, couple of hundred stocks under coverage. We've got a pretty good feel at most points in time where the relative value for both the current holdings and the potential holdings are. And that's a pretty organic process, and the conversations happen when they need to happen. And to the extent that Hamish or some of the other portfolio managers might have missed something, the analysts absolutely will come and remind us that there's something we should be looking at that perhaps we're not.
Without giving away your trade secrets, what do you define as quality?
Yes, we're not sharing any trade secrets here because we're very public about this, and listeners can jump on the website and we go through these things. But we've applied for qualitative criteria when we discuss a business's quality. And the first is its economic moat, which will probably be a concept pretty familiar to most listeners, but just in case, effectively we're talking about a business's competitive position and whether it's advantaged in its industry or whether it's challenged, just given its competitive prospects. So, we want businesses effectively, this is, the corporate castle, and Buffett talks about having a big, wide moat filled with crocodiles and piranhas and all those sort of things. And that's what we're looking for. That's the most important qualitative criteria we apply, and we just want those businesses with wide, hopefully widening, but just importantly, enduring moats as well. Not those businesses that may be subject to competitive threat or competitive disruption in the near to medium term. The second qualitative criteria is something called business risk that we think about, and that can be anything that would impact a company's earnings or cash flows over any period of time. That can be things like its exposure to just the broader economic cycle. You think about luxury companies, of course, they're exposed to just general economic conditions. It can be things like their exposure to regulation, be it favorable developments in regulation or unfavorable developments. Anything that would impact the predictability around that company's earnings and free cash flow stream in the future. The third thing we consider is something we call agency risk. And here we're really thinking through the behavior and the incentives of the board of directors and management as stewards of our clients' capital. At the end of the day, we co-invest in these funds as well, but we're fiduciaries of our clients' money, and we want the companies that we're investing in to be good stewards of that money, which means they're thinking in terms of owners themselves. They're incentivized to behave like owners themselves. They're not out there trying to just empire build for its own sake. If they are doing acquisitions, they think it's value accretive. They behave well from a capital allocation point of view for all shareholders, minority and majority shareholders. And the fourth and final criteria on quality is something we call reinvestment potential, which we think about as a company's inherent ability to reinvest its own cash flows within its business at a very high level of incremental return. And so a classic example for us would be something like Starbucks, which has a very large and profitable and a business in the US that is still growing, but it's quite mature. But really the compounding machine for Starbucks going forward will be their China operations, where they've got about 4,000 stores on the ground in China at the moment, but they're opening about 600 stores a year. And for listeners doing the maths, that's one about every 16 hours. And growth for its own sake isn't particularly appealing to us, but for Starbucks in China, when they open one of these new stores, they get about an 80% return on capital or return on investment from that new store. And they have a runway of certainly years and potentially decades of rolling out these stores with returns may not stay as high as 80% over time, but that's an incredible starting place. And the ability for a company to retain its earnings and retain capital in the business and reinvest it on your behalf as a shareholder at something like 80%, it would be lovely for me to sit here as a portfolio manager and say I can compound my client's money at 80%. I'm highly certain I can't do that.
Back yourself.
But certain businesses, or at least parts of certain businesses, can compound for you. So we think that's often an overlooked but incredibly important source of quality, is that a company's ability to retain capital and reinvest at very high rates over a long period of time internally within its own operations.
It's fascinating. I could listen to you talk about investing for a long time. I guess the second part of it is, so once it passes the quality filter and is in the investable universe, you then touched on the valuation side of it.
Yeah.
And I think for new investors, and definitely speaking personally for myself, valuation has always been a real challenge.
Yep.
Because you change an input and all of a sudden the value you get is very different. So how do you think about valuation in terms of all of these quality businesses and making a decision around which ones actually make it into the fund?
Sure. Yeah, it's a great question. And it's absolutely true that I think some people get scared off by the valuation formulas when they start seeing the Greek letters and things like that. There's two lenses through which we think about valuation. And the first is a pretty classic and traditional discounted cash flow methodology, where we're trying to, recognizing there's no precision around this, but within a reasonable range, trying to think through what a company's future free cash flows would be from now until Judgment Day, and discounting all of those cash flows back to a present value, what all those future cash flows are worth today at that present value. And so that is very much where we rely on the work and the modeling that the analysts do, and their very deep knowledge of the company itself and the industry that it's operating in, so that they can put forward what they think, he or she think, is a reasonable estimate for a company's cash flows next year and the year after that and the year after that for as long as we want to think about the future. And then we think about a way of just discounting that back to a present value today. And that discounting process is where people start talking about betas and capital asset pricing models and all those sort of things. We try not to be too cute around those sort of things because valuations, to your point, are very sensitive to some of the assumptions you use when discounting those future cash flows. But we try and be very sensible around what we think reasonable assumptions are for risk-free rates and appropriate discount rates, and standardize them as well. So people aren't out there, our analysts aren't out there applying different discount rates to different companies where it's inappropriate to do so. What we really want them to be thinking about is the future cash flows and the future coupons from those businesses. And then we kind of standardize the discounting process to arrive at a present value. And then you get your sort of classic margin of safety calculation, because that net present value of those future cash flows is also called an intrinsic value. And your margin of safety is simply where that intrinsic value is for a company relative to its share price today. And obviously, the bigger that margin, the better, very simplistically. The second lens through which we think about valuation is something we call a total shareholder return, which might sound quite complicated, but I'd sort of stress that it needn't be. What we're trying to do with that TSR, total shareholder return calculation, is just think through, it's more of a kind of shorter to medium term estimate of what a company's return profile or prospects might be. And what we're doing is thinking through the earnings or earnings power for a company over the next sort of 3 to 4 years, applying what we at Magellan think is an appropriate multiple, a sort of PE or price to cash flow multiple to those earnings a few years out. And so therefore you can estimate from where the share price is today, where we think the share price will be a few years from now. And then you add a dividend yield to that if a company pays a dividend, and you have a sort of rough estimate for the 3 to 4 year return profile from that company. I'd stress across both the discounted cash flow and the TSR lenses through which we can think about valuation, we are stressing ranges here. We're not trying to get anything to 2 decimal places of precision. That can be a very dangerous way of thinking. We're always trying to think probabilistically and within a range of likely outcomes. And so this is a really fun part of the interplay between the analyst and the portfolio manager, is we require almost our analysts to express their view on both the intrinsic value and the TSR for a company. And that will be his or her perspective on how the prospects for that company may unfold over the short, medium, long term. But that's just one person's opinion. And then something I think we do quite well at Magellan is we get a whole range of different opinions. It might be Hamish will have a different opinion on what an appropriate multiple should be in that TSR calculation, or different growth rates for revenues or earnings. And this is where things can start to get a little bit complicated, and we probably shouldn't get into the weeds too much, but it's that range of opinion and that discussion and debate around trying to get a firm grasp on the likely prospects, not with any precision again, but just the likely return profile for a company, I think is something we do quite well at Magellan. And then the portfolio construction piece, we're trying to, all else equal, you want things with a very large margin of safety and a very high TSR. That's nirvana for us, all else equal. But of course, things are never equal. And so what we are also trying to optimize for is incredibly high quality businesses, because even within our universe, there is a range of quality. Not everything is top tier. What we really, really want is the highest quality businesses we can find at the lowest valuation. And that's the sort of optimizing work that Hamish and the other portfolio managers are doing at any point in time. And we have, as I mentioned, just the internal dialogue helps us with that. We've got some tools as part of our process to surface those sort of ideas, just in case we're missing anything. But that's sort of kind of the nuts and bolts of how the investment team at Magellan spends an average day and an average week. We've got people thinking through the quality of the business, the prospects for that business, and then trying to construct a portfolio for that portfolio's own objectives based on those 200 or so companies that we cover, each having slightly different quality profiles and slightly different return and risk characteristics. And that optimization process is really where Hamish steps in and does his thing.
So, Chris, whenever you read about Hamish or some of the stuff that Hamish writes, he always talks about looking through the windshield, not sort of looking in the rearview mirror in terms of how he thinks about investing. A lot of people often invest in what has been rather than what is to come.
Mm-hmm.
And I guess that is what Magellan has been so successful in being able to do, investing in the big themes. What are some themes that you kind of see being significant over the sort of next 5 to 10, maybe 50 years?
50
Asking for a friend.
50 might be a little beyond the horizon. Look, I mean, some of the things that we have invested in that have worked really well for us, we continue to like. Things like the shift to cashless society and the digitization of payments and things like that. I mean, that is a tailwind that will continue to benefit certain businesses potentially for years, if not decades to come, because there is still an enormous amount of transactions that take place around the world via cash and check. And that conversion to some sort of digital form of payment does not happen overnight. It just gradually plays out over time. So that's a thematic. It's not a new one, but I think it's one that still has legs, and hopefully our clients continue to benefit from that over time. One of the ones we've started thinking through more recently at Magellan is just the size and the opportunity to expose clients through very, very high quality businesses to the growth in consumption in China that is likely to play out, again, not in the next quarter or the next year, but for the next number of years and potentially the next few decades, just given the enormous growth in the middle class and the affluent class in China, their spending power, their wealth, and how certain businesses incredibly well positioned to benefit from that tailwind, again, for many, many years. And I mentioned Starbucks earlier, their ability to open 600 stores a year at very high returns. Businesses like Alibaba, which is a relatively recent investment for us. I mean, you talk about, we spoke earlier about patience and the thoroughness of the process at Magellan. Our analyst, Claire, has spent effectively a couple of years just getting comfortable, getting her hands around Alibaba and its quality. It's quite a unique business because it's in so many different parts of the Chinese ecosystem. So it not everything takes that long, but it speaks to the process that we give the analysts a lot of time to go away and do the digging that they want to do to prove up the quality or otherwise. But then Alibaba is, incredibly high quality business that is, effectively a toll on consumption in China over the coming decades, given its exposure to e-commerce, its exposure to delivery and fulfillment in China, to payments in China, to digital entertainment in China. I mean, it just touches so many parts of the economy. And it, like Starbucks, sort of plays more at the mass to upper middle class part of the demographic pyramid in China. Then you have other business like Estee Lauder and LVMH, luxury goods companies or prestige cosmetics companies and skincare companies that really stand to benefit from the explosion that we expect right at the top of the economic pyramid in China. So that's another trend or tailwind that we've managed to find some really high quality businesses. I always come back to that, the importance of high quality, because there are so many seemingly obvious trends and industries that benefit from tailwinds over the years and decades to come, but where it's not apparent to us, we can access them through high quality businesses. And it's all well and good to have growth in your industry, but if you can't predict who the winners will be 5 years or 10 years from now, that's just a game we don't want to play. We don't want to expose clients to that risk. Not to say that others can't. I think maybe we're just good at recognizing where we are operating within our circle of competence and where we don't have any edge in terms of understanding currently.
What's an example of an industry that fits that?
I mean, the one that the investment community and the talking heads love to talk about, and this is just front of mind at the moment because they reported overnight, is Tesla, where I think we'd probably all agree, and I think there's some logic to suggest that over time the electric vehicle industry will be meaningfully larger than it is today for all number of reasons. I think it's just much harder for us for all the advantages that Tesla seems to have today, first mover, genuine technical advantages, scale, all those sort of things. It's an industry where you are competing with a lot of very well-resourced, very capable auto manufacturers who are investing heavily, it seems, in building their own electric vehicle capabilities. And so I would just have less conviction that a business like Tesla will be the leading electric vehicle manufacturer 5 and 10 years from now, and a high degree of conviction that, say, Visa and MasterCard will still be the two dominant card networks in the developed markets 5 or 10 years from now.
So, Chris, thanks for your time today. This has been great.
Pleasure.
Very interesting to hear how you think about stocks and to hear some of the examples that you speak about. We always finish our interview with a final 3 questions, so we'll jump into them. The first one is, do you have any must-read books?
I think they're all going to be the ones, anyone that's come up in sort of reading about Buffett and hearing about Buffett, there's all the classics, right? You've got, of course, Ben Graham's books, Security Analysis, Intelligent Investor. There have been a number of good books written about Buffett. All of his letters, I think, are a must-read. They're great. Seth Klarman's Margin of Safety is a classic. I think everything by Howard Marks, both his books, all his memos, incredible. He is such an effective communicator. But I suspect most of those things are probably considered table stakes and should be. They're incredibly important for sort of laying a foundation in terms of how you think about investing. But some things, maybe a book that others haven't heard of, a very good book that I read with a whole number of different lessons and takeaways is called Ship of Gold in the Deep Blue Sea, it's a fun read and it's a fascinating read. And if anyone should pick it up and read it after this, I strongly, strongly, strongly recommend not to read about the main character and what has happened in his life after the events of that book, but to read the book first and then go and research what's taken place in this person's life afterwards. There are as many lessons in the book as there are from reading about what happens after the book concludes. It's a fascinating topic.
Fascinating. Definitely put that on our list. The second question is, what's your go-to source for investing information?
Other than 30 analysts.
Yeah.
That's kind of the answer. I mean, they're an incredible group of people, and they flow a lot of high signal, important information through to us, help act as a filter. But then I think these are going to be pretty standard responses to anyone who's thinking about global investments. I think The Economist is an incredible publication. Financial Times, The Journal, New York Times, those sort of things. There are a lot of newsletters that I used to subscribe to, less and less over time, and Forbes and Fortune, those sort of things. They can have an episodic article, which is incredible, but the rest of it is probably a little too short-term focused for our purposes. And I'm experimenting recently with sort of the Twitter community, just to sort of be very specific and curated in terms of those people that I'm following. But there is I've been surprised by the amount of knowledge that exists out there, and people you'll be very careful about this and not exposing yourself to too much, but the high quality of conversation that takes place within certain users of that platform.
And then the last question, if you think about back to your early career, or, when you were preparing to go to that first Berkshire Hathaway annual meeting, what advice would you give your younger self?
just get smarter quicker. I mean, it's a bit of a flippant comment, but I think one of the lessons as I reflect back is just, you're so naive, and I'm still so naive, and it's this funny, I'm pausing because every time you think you learn something and you gain some capability or mastery of something, you just realize how completely naive you are about a topic and how much more nuance there is to it. And so I'm not sure what advice effectively, how to sort of make that advice tangible to a younger self, but it's just to try and expose yourself as young as you can to as many different ideas as you can, to just sort of adopt that Munger principle of lifelong learning across many different disciplines, because you sort of realize, I've always felt that the level of knowledge I should have, I'm always a couple of years behind that. It's fascinating whenever you're constantly trying to chase a level of knowledge. I feel like I'm not doing a very good job of describing this. What I'm trying to say, maybe via analogy, is I sort of feel like, if I was standing on an island, I feel like the tide is constantly receding, and in so doing just reveals the level of knowledge that you don't have. And in spite of feeling like, you read a lot, you do a lot of work, and you've got a bit of knowledge, in an absolute sense, I can tell that the level of knowledge I've had over the last decade has improved. But in a relative sense, I suspect I'm less smart than I was 5 years ago or 10 years ago, just because you know there's so much more now that you don't know. And that's fun, but it's also very daunting.
Yeah.
It's half the fun of investing, right? The constant chase.
Yeah.
Chris, thanks for joining us today. Been a fascinating conversation. We'd love to continue, but unfortunately, we've run out of time. If our audience are interested in backing you in and investing in the High Conviction Fund, or even getting a bit more information about Magellan, how can they do so?
The website's an incredible resource. I'd suggest people head to the website. There's plenty to read there. There's fund reports, so people can learn more about the individual fund themselves, or just the website itself has a lot of content in terms of the broader principles and process and philosophy that we follow. And if people want to learn more beyond that, they have contact details for our marketing and distribution team online as well. So there's plenty of avenues for people to follow up with people directly at Magellan.
Awesome. Well, again, thanks for your time. Appreciate you coming on, and hopefully we can touch base again to find out what Magellan's up to.
Pleasure, guys. Thanks for having us.
Thank you.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.